Hi everyone, and thanks for checking out my channel. In today's video I'm going to do something a bit different and going into more details about one of the strategy I'm using, especially to trying to find reversal for entry point to trade large swings. That technique or strategy is the RSI Divergence. So I'll go through some explanation about what is RSI. What does it mean on the chart? What does it actually mean in terms of the buying and the selling on the market? And I'll finish with some tricks about the RSI that are useful, hopefully, and to avoid falling into some traps that all indicators basically having some. Just for reference, I'm only using the RSI indicator. That's the only one I'm using in all of my trading strategies, and I'm mainly using it just for divergence, not even for overbought or oversold level. So to me this is very important, so yes, hopefully you'll get something useful out of it, and yeah, let's get started. So first, I'll start with explaining what the RSI divergence is. So basically you got the price moving up. Let's say that one we're going to have a look at the bearish divergence and making a new higher high, and the RSI underneath is also moving with the price, moving down and moving up, but cannot actually make a new higher high as the price, and that's the divergence. So between this and this, so these two are diverging one each other. So this is what's called bearish divergence. Of course you have the opposite when it's actually the price going down, and then you see the bullish divergence when basically the RSI is not making new or lower low and instead making higher low. So that's the theory. What it means on the chart, so I'm gonna look at the crude oil, for example, here in that move back end of 2018 here. So we can see drop in price. I'm going to make that a bit more visible here. There. That point here, we had a low on the RSI. Then the price kept dropping here, while here at the bottom we can see that the RSI was making higher lows. Sorry, it's wrong. Down here, yes. So yes, that's what it means on the chart. So basically the price keeps coming down, but the RSI is actually moving up. So what does that mean? I mean, before going through a couple of tricks, what does it mean back in here? That basically the momentum of that move is losing power. The RSI is calculating large candles, red and green, and make some calculation to get a number. So where basically the RSI is dropping or not increasing, at least it means the momentum is moving down. In terms of the buying and selling pressure, it can be a sign that the large funds or the big players are actually not pushing the move anymore and might be actually reversing, while the small accounts or small funds or retail traders kept on actually buying into the trend while it's actually already reversing. So that's the theory behind and why it is actually pointing to potential reversal. So back on the tricks here, it has to happen on the highest possible time frame. So for point number one, the lower the time frame under 1 hour is less reliable. It can be useful for someone day trading and trying to catch up some really small trade, but for swing trading, positional trading, when time entry for large swings, you need to have at least the 1 hour. The 4 hour is better, and you can get divergence on the daily chart similar to that one. That one is on the daily. This is much better, and if of course it's already in a very low, in oversold position, you even have more chance for your trade to be successful. Probably another one need to talk about is when you have this divergence here, it doesn't mean that will reverse straight away. So you might have to wait for quite some time. For this example here, the price kept actually going down despite the first divergence. So if you keep moving here, you have that leg here, and it made another touch on the RSI trend line here. So, and almost 15% down from the first point, or if you take down as the first divergence. So it's a significant drop, almost 20% actually, that you need to be aware of before the price did actually reverse for good for what was a successful trade, as even your long entry here 53, and then you could technically exit on the next divergence here, because that works actually for exit point as well, when here the momentum was dropping and it was showing that this movement was pointing to the end, and that would have been the trade between 53 and 66. So obviously not highly efficient, as you would have to pay some drawdown down the line, but the idea in the strategy is to enter first one here and adding to each touch on the RSI trend line until you get to full position. So your average price would be more about probably 49 or 50, somewhere in the middle. But that's something, yeah, to keep in mind. So the second point here is that the last leg of divergence, so potentially that move here, is pure emotion. What it means is while you're going to see some drawdown on your trade and some unrealized loss, you will also hear a lot of noise about the market crashing to zero, or that's basically the end of that commodity, and everybody saying that the price will never recover. So you'll have to psychologically be really solid to hold that trade and not give up in this area here, which would be the worst time to exit the trade. So one technique here to avoid that is to set your stop loss should the RSI momentum return. So if that RSI would be breaking that trend line, then you would exit the trade at loss, because it means that potentially the price can resume the move down. But this is something to keep in mind, that the pure emotion running at that time will be quite hard on the trade to keep. Similar here, it's the same thing. The divergence is showing a drop in the momentum, but the momentum can return. It's only a higher probability trade. It doesn't mean that it will be successful 100%, of course. Sometimes you can have strong moves followed by divergence, but that's not reliable. Quite often on the hourly chart, you will see a huge peak on the RSI, and then the next higher high on the price will actually not happen with a new higher high on the RSI. But that's normal, because the first momentum was so strong that the second one cannot actually go over it. So that's not something to trade, and it's definitely not a bearish signal. And it's only saying that you had massive momentum, then you have a bit less momentum, doesn't mean the price is going to reverse. And another last thing to keep in mind, that each market is different. The RSI is not working on each market the same. Crude oil is very typical for this. You can have that kind of 20% move from the first touch to the divergence trend line. It's almost normal. I think if you look at the history, it may have done even more than 20% down. So you need to keep that in mind and scale your entries to make sure you don't actually enter full position at the first sign of divergence. That would be too early, and that will be risky, because if the trade continues down, of course, but also it will reduce the performance of the trade. So yes, something definitely also to keep in mind. Stage the entries, never go in one go. And yes, each market is different. Some are reacting very quickly after divergence, some are not, and also some are reacting more on the daily chart, some other on a 4-hour chart. So it all depends. So you need to know your market. So yes, that's about it. I think I went through the main points, just going through a quick summary of what I just explained. The RSI divergence is pointing to a switch of the smart money position for the reason I explained, because the loss of momentum can be potentially due to smallest funds buying or selling into the trend. But the large funds, the big players, they would have already started to switch position. Second one, RSI can be invalidated, so it's not RSI divergence can be invalidated. So of course, if the momentum resumes for some reason, then you can see the divergence invalidated by the trend line getting broken. For example, here the price would have actually continued down here and the RSI broken under, say, 22. It would have meant that the divergence would not have been valid anymore. RSI divergence can happen several times, as we have seen in that example. So it can make several touches, and as the price moved on from here to here, you had to wait quite some time before you see the actual reversal. The RSI divergence trading strategy is definitely a drawdown strategy, so you're going to see some unrealized loss, except if you're really lucky and that the reversal happens straight after the first divergence, but that's quite uncommon, I would say. Next point is the RSI divergence works mainly best in trend. When you're ranging or when the trend is not clear, then it's probably not best not using the divergence, because it's really just not reliable. And also you need to have some nice trend like this one. It was really clear, making clear higher lower high, lower lows continuously on the significant time frame, like the daily. So you had the trend very powerful and it had to reverse at some point. So that's the kind of trend you'll be looking at. And finally, which is quite obvious, but you don't actually trying to get RSI divergence on area that are not support or resistance levels. So down here, for example, I don't believe we had massive support in that area. There was some support here, but definitely not here. So that would have been cautious entering long here, because the signal was too weak and not on a very good area of support, when actually here, when you dropped under 46 down to 42, you know that this area will be hard to break. So divergence is definitely more meaningful in that kind of setup. So yeah, that's about it. I hope that was useful and you found some interesting things in here. If you have any question, don't hesitate in the comments. I'll be happy to answer and help. And yes, speak to you soon. Cheers, bye.